Hey, you're listening to Three Clowns. I'm Alex, and welcome to episode 9. It's Wednesday, April 16th, and we've got something weird to dig into this morning. The geopolitical fear trade basically evaporated in 48 hours. Nobody's talking about it anymore, and suddenly we're all in on AI productivity again. But here's the thing. We need to figure out if that's actually backed by earnings data, or if it's just a really confident bet on lower rates. Tom and Ray are here, it's early, and we're about to find out.
Yeah, I'm here. It's too early for this to already be confusing.
Tom, buddy, it's only confusing because you haven't had that second pot of coffee yet. Good morning, guys. I actually feel pretty good today. Yesterday, I spent about 3 hours trying to fix a leaky faucet in the kitchen, and honestly, just achieving a dry floor was enough of a win to carry me through the whole week. I'm ready to dive in.
Yesterday, I tried to throw out a single sock, and I couldn't do it. It felt like I was creating a problem that was going to outlive me.
Tom, that is the most macro way I've ever heard someone describe laundry. You're worried about the long-term liability of a missing heel. I get it, though. Yesterday, I felt that way about a single screw for that faucet. It feels like if you lose one piece, the whole system just goes to zero.
Okay, so here's what I'm seeing. Yesterday, we got this massive AI productivity dump. Morgan Stanley found that a quarter of the S&P is now actually quantifying AI benefits, up from like 13% a year ago. And suddenly, the whole geopolitical hedging premium just evaporated. Gold down, oil down, risk on across the board. The Nasdaq ripped while the Dow basically flatlined, which tells you everything you need to know about where the money's flowing. But here's the question that's actually keeping me up, and we're going to spend the morning on this. Is this a real earnings inflection moment, or is this just the market making a very confident bet that the Fed's going to cut rates, and therefore everything with growth gets cheaper? We've got 5 calls still live this week. Nobody's making new ones today, so we're going to spend the hour picking apart what actually happened yesterday and whether it holds up when people actually report numbers.
Yeah, the 25% number sounds like an inflection, until you realize most of that is, we will save money eventually, and not, we made money yesterday. Which is fine. That's basically a rate cut with a PowerPoint. Nasdaq ripping while the Dow does nothing. That's the market very politely saying, we are buying duration and calling it innovation. Banks actually printed real numbers, nobody cares. Microsoft goes plus 4.6% because it said, Copilot, 6 different ways. On my AI is rate bet thing, this doesn't break it. If anything, it tightens it. The story only works cleanly if that 10-year isn't drifting back up while everyone's trying to pull forward 5 years of productivity into today's multiple. NVIDIA at 200. Yeah, we're still underwriting perfection, just with better vocabulary now.
Tom, a rate cut with a PowerPoint. I am absolutely stealing that for the notebook. It's the perfect way to describe the mood. We're trying to code our way out of a sticky macro problem. But look at the 10-year this morning. It's sitting at 4.282%, which is actually a few pips higher than yesterday's close. If the AI productivity miracle was actually going to do the Fed's job for them and cool things down, that yield would be dragging, not creeping up. And gold. It dropped yesterday because everyone breathed a sigh of relief on the geopolitical headlines, but it's already snapping back pre-market, back up to 441. That tells me the inflation basement is finding fresh oxygen. See, if this was just about war, gold would have stayed down once the headlines faded, but it's bouncing even as yields rise. That's a signal that investors aren't just hedging a conflict anymore. They're hedging the fact that the Fed's sledgehammer hasn't actually put out the fire in the economy's foundation. They're buying the metal because they'd rather hold something physical than a bond that's losing its grip.
Okay, so we've got a 10-year that won't stay down, gold that's already bouncing back pre-market, and a market that's basically trying to buy growth on sale while pretending the structural stuff doesn't matter. That's our actual story, not the AI headlines, but the desperation underneath them. Let's hit the tape and see what actually moved the needle yesterday. Yesterday was the day the market decided it was done being scared. Geopolitics took a back seat, and suddenly every mega-cap tech stock that can whisper the word AI got bid up hard. What's interesting isn't that it happened, it's how narrow it happened. The QQQ's up 1.4, Dow basically flat, which tells you exactly where the conviction is right now.
So we're calling it AI fundamentals. But it only works in the longest duration assets on the board. Feels like rates went down in people's heads, not in the market. You think this holds if the 10-year ticks up 20 bips?
Tom, I hate to break it to you, but we're already halfway there. The 10-year is sitting at 4.282 this morning. It actually crept up from yesterday's close. It's fascinating watching the QQQs just blissfully ignore the very thing that usually kills them.
Yeah, so here's the thing. 25% quantifying benefits is real progress, and Microsoft moving 4.6% on Copilot mentions tells you people are hungry for the narrative. But when 75% of the market still can't put a number on what AI actually does for them, you're basically paying a story premium on assets that haven't yet proven the story works. And the moment someone big reports and the benefits are fine, not transformational, the repricing gets ugly fast.
Yeah, you're underwriting 5 years of margin expansion today, and the discount rate you're using is basically vibes. Move that rate 50 bips the wrong way and suddenly Copilot's just a nice feature. The math works, at one very specific interest rate.
So the thing that should make you nervous is exactly what made Wall Street happy yesterday. Morgan Stanley beat by almost $1 billion in trading revenue. Bank of America's consumer is healthy. Citi's net income up 42%. All of it trading heavy, all of it saying the same thing. The flow of money between rich people and institutions is moving fast and profitable, while the Dow finished in the red and industrials got crushed 1.25%. The banks are having a great quarter because volatility is high, risk appetite is selective, and capital is moving somewhere. But that's not the same as the real economy being fine. It's more like Wall Street is winning while Main Street's market tells a different story.
It's the ultimate irony. The Fed's high-rate sledgehammer was meant to cool the engine, but it actually created this massive volatility that the big banks are essentially taxing through their trading desks. If all that profit is just coming from institutions repositioning rather than Main Street actually building things, isn't this just a very profitable game of musical chairs?
Yeah, it's musical chairs where the music is set by the 10-year. As long as it drifts, everyone looks like a genius rotating risk. The problem is when it stops, because then you find out who was actually sitting and who was just holding someone else's duration.
Speaking of musical chairs, the other half of yesterday's rotation was folks getting out of their war hedges. Gold and oil both down hard on de-escalation. Except that trade's already halfway unwound in pre-market, which tells you something important. Investors took yesterday's geopolitical all clear as permission to de-risk, but they woke up this morning realizing the actual problem. Inflation's stickier than the headlines. So gold's back up, oil's up, and now you've got this weird moment where the safety unwind didn't actually stick because the thing you were actually hedging never went away.
Yeah, the market did the problem-solved trade on a headline, then woke up and remembered the problem was the price of money, not the news cycle. Rates didn't move yesterday. People's imagination did. And now it's correcting back to math.
Ray, what'd you catch in the weeds this morning that nobody's talking about yet? Let's mode to the footnotes. Ray, before we reset, 3 stories that got buried but shouldn't have, and you've actually got the thread on all of them.
Well, it was one of those days where the screen looked like a glow-in-the-dark mini-golf course, but the ground was a bit, shaky. Yesterday I was digging into the Fred data on household cash versus market entry points, trying to find where the fuel for this rally is actually coming from. And then I saw Coinbase and MicroStrategy just vertical. It's pure beta. When tech and AI have a big day, the overflow just washes into crypto like a tidal wave. But then we get this report about regulators eyeing trades right before that afternoon Trump post. I mean, the timing is so loud it's almost funny, but it points to a much bigger macro problem. If the speculative end of the market is being driven by people front-running social media rather than a shift in the 10-year yield or a change in Fed posture, then we aren't seeing a healthy risk-on environment. We're seeing a market that has decoupled from the actual cost of money and is just hunting for liquidity gaps, which means the recovery isn't about the economy getting better. It's just people playing the plumbing, and that's a very fragile way to build a bull market.
If the fringe is getting front-run off tweets, what does that say about NVIDIA or anything else? Are we still doing price discovery or just sentiment with better branding?
Well, I think it's actually both. The mega caps are still pricing in real-world cash flows, but that speculative tail, the crypto proxies and the meme-adjacent stuff, that's 100% sentiment with better branding. The reason that probe story matters is that price discovery is a spectrum, and if the tail starts wagging the dog on a random afternoon, it gets messy. Because the real danger is when that fringe sentiment starts bleeding into the assets that are actually supposed to be grounded in reality. MicroStrategy was up 4.45% yesterday on nothing but beta and vibes. And that's exactly the canary.
So Ray, before we move on, United and American supposedly had merger talks floating around yesterday. Is that an actual thing that could happen? Or is this just one of those stories that gets people to trade airlines for an afternoon and then disappears?
Oh, Alex, that's a trial balloon if I've ever seen one. And honestly, the DOJ would probably set their desks on fire before letting two of the big four merge in this political climate. But you have to look at why they're even leaking this stuff. Yesterday, I was digging into the operating margins and the fuel spreads, and the reality is that between those massive new pilot contracts and jet fuel that just won't quit, the math for these airlines is getting really ugly. When a company floats a regulatory long shot like this, it's usually because the organic path, just running the business as a standalone, looks so rough that they feel forced to sell a scale fantasy to the market just to keep the share price afloat. So the real headline isn't a merger, it's a distress signal that the sector's cost structure has become a trap they can't build their way out of anymore.
Yeah, when the spreadsheet stops working, they start drawing org charts. Happens everywhere. It's not synergy, it's we ran out of levers.
So that Goldman warning on private credit, is that a real risk signal buried under turf war noise? Or are they basically saying investors don't understand what they're buying because the returns look too good to question?
Oh, it's the ultimate Spider-Man pointing at Spider-Man moment. Because Goldman definitely wants those fees back in the public markets where they can actually trade the paper. But yesterday, I was looking at the gap between public high-yield spreads and some of these private marks, and the divergence is just, it's wild. Well, the why here is all about what they call volatility dampening, which is really just a polite way of saying these funds don't have to admit the house is on fire as long as no one tries to leave through the front door. Because in a public market, when the Fed keeps rates high, your bond price drops instantly to reflect that new reality. But in private credit, they can just smooth the valuation and act like the higher cost of debt isn't eating the borrower's cash flow alive. It's a massive liquidity mismatch where investors think they've found a magic box that pays high yield with zero price swings. But the reality is that the Fed's sledgehammer has landed. It's just been tucked away in these private contracts that haven't been forced to face a real market price yet. Eventually, a big institutional player is going to need liquidity and try to exit. And that's when we're going to find out the exit price is nowhere near the appraisal price. And that is exactly where the real economic damage from these rates has been hiding, while the equity market was busy making new highs. All right, Tom, take us into Nerd Corner.
So Tom, before we get crushed by the close today, help us understand what it actually means when a quarter of the market is basically betting on a single technology that doesn't have a business model yet.
Yeah, so Morgan Stanley puts this out. 25% of S&P companies can now quantify AI benefits, up from 13% a year ago. Which sounds like an inflection. It isn't. Not really. It just means we've moved from "this might help" to "we can point to a line item," and it's still concentrated. Tech at 42%, financials at 40%, so the rest of the market is basically watching from the hallway. The equity math here is the uncomfortable bit. At 35x forward, NVIDIA, and honestly the whole complex, isn't priced on that 25%. It's priced on that number marching relentlessly towards something like 60, 70, 80% adoption without friction. And that only works if your discount rate cooperates. Which it isn't, because the 10-year is just sitting there at 4.28 like it's waiting for something to break. Microsoft goes up 4.6% on Copilot is working, which is fine, but mentioning AI and extracting durable cash flow from it are two completely different sports. The real risk isn't that AI doesn't work. It's that this rate of companies proving it works slows down, even slightly, and suddenly you're not compounding the story fast enough to justify the multiple. And when that happens, multiples don't gently adjust, they reset all at once.
Tom, that's the scary bit. If these AI giants are just locking in 20-year nuclear power deals and ignoring the cost of capital, does the Fed even have a lever left to pull on them? Does that 4.28 on the 10-year eventually break the math? Or is this whole sector just operating on its own planet while everyone else feels the squeeze?
It's both, just not at the same time. Operationally, they've insulated themselves. Long-dated nuclear PPAs, fortress balance sheets, so CapEx decisions don't flinch every time the 10-year ticks up 10 basis points. But the equity doesn't get that luxury. The stock is just a stream of future cash flows discounted back at whatever that 10-year says money costs today. So you end up with this split reality where the business keeps building like rates don't matter, and the multiple quietly compresses because they do. And if the 10-year just sits here, nothing breaks operationally, you just stop getting paid 35x for it.
So, if the multiple is supposed to compress but the narrative keeps people from looking at it, are we basically watching the price stay flat while the fundamental return shrinks? Or does it actually have to drop for people to notice something's wrong?
It's usually the quiet version. Price goes nowhere while earnings run underneath it, and the multiple just shrinks without anyone admitting it. That's actually the bull case, because you're letting reality catch up without forcing a reset. The problem is when earnings even slightly miss that glide path, and you're still sitting on an elevated multiple. Then it's not sideways, it's down fast. Watch NVIDIA at 200 with the 10-year at 4.28. If one of those moves and the other doesn't, that's your tell.
So before we score how badly we've missed this week, let's check the tape on what we actually said versus what actually happened. All right, scoreboard. Tom's got both pieces of his episode 8 call still alive but needing serious legwork. The 10-year stalled, NVIDIA's drifting the wrong way. Ray's got a problem. His episode 8 call is moving backwards and his legacy call from episode 5 needs 14 basis points in one day. And my episode 8 call was the narrowest possible range on the 10-year, which means I'm basically betting nothing happens, which, given this week, might be either the smartest or dumbest position in the room.
My episode 8 call is structurally intact, but the market's just not cooperating. I need rates to back up another 7 basis points, which only happens if this little duration squeeze stops and people remember term premium exists, and then NVIDIA to drop 6 to 7% at the same time, which requires someone to care about valuation again. Right now, it's a very elegant theory being ignored in real time.
Elegant is a very kind way to describe a parlay where you need the 10-year to spike on inflation, while the AI bid simultaneously decides to die on valuation. You're fighting the exact same momentum on both legs of that trade, Tom. It's a tough way to live. And if you think Tom is in trouble, look at me. My episode 8 call for 415 is currently drifting out to sea because that ceasefire premium evaporated overnight and yields are creeping up this morning. It's honestly impressive. My legacy call from episode 5 is sitting way up at 442, so I've managed to bracket the current price with two predictions that are nearly 30 basis points apart. I basically bet on both a global peace dividend and a total bond route in the same month. And right now, I'm just getting a very loud lesson in how the middle of the road is the most dangerous place to stand.
That's not a hedge. That's just two incompatible stories you liked equally. Market picked neither.
So my episode 7 call on the QQQs is basically a lock. We're already at 639. I called 625. That's nearly $15 of cushion before Friday close. But my episode 8 call, I called the 10-year settling between 4.22 and 4.28, and we're sitting at 4.282 right now. I'm already outside my ceiling by a single basis point. The irony is I made the narrowest possible bet, the boring nothing happens call, and the market decided to push just hard enough past it to make me uncomfortable. Rates are creeping up this morning, so I'm basically one bad print away from being completely wrong about the one thing I was most confident would stay still.
Alex, that is the macro gods having a genuine laugh at your expense. You went for the safe trade and found out that in a market this jumpy about the Fed, silence is actually the most expensive thing you can buy. Trying to pin the 10-year to a tiny range is like balancing a pencil during an earthquake. It's the hardest bet to win because the market simply doesn't do still right now.
Right. See you tomorrow, assuming the market picks a direction, or we all just slowly lose confidence instead.
Go get your coffee and stay curious, because the real story is always buried a lot deeper than the first tick of the morning.
That's a wrap on 3 clowns. We've got calls on the board, we've got futures that haven't decided what they want to do yet, and we'll be back tomorrow to see which of us was right and which of us was just confidently wrong. 3 Clowns is everywhere you get podcasts, and you can find us at 3 Clowns Pod. Thanks for riding along with us this morning.